Hello and welcome again. This is Robert Schein, Managing Director and partner of Blanke Schein Wealth Management. Well, today is Tuesday, the 26th of May. I trust everyone had a safe and healthy and hopefully active Memorial Day weekend. And thanks to all those servicemen and women, past, present, and future. Thank you for all the sacrifices you've made for all of us. So we really appreciate that. Today we want to discuss three topics. Today we have exciting news that the S&P 500 broke out to the upside of 3,000. We've been talking about the range for quite some time, and we'll get into exactly what the S&P means right now and where we are as what we see here at Blanke Schein Wealth Management. The next thing is, are we going to see new highs from this point forward by year end? It's a possibility. We can discuss that today as well. And the final topic we'll discuss is inflation coming? And I think the answer, we all kind of know the answer is yes, but the question is the timing of it and what it looks like and how do we position accordingly. So let's get into our topics today. So markets opened up big today in anticipation of, as we see, all 50 states now are in some form or phase of reopening. And there's several good green shoots out there, signs of life, if you will. On CNBC this morning, they had Professor from Wharton Business School, Jeremy Siegel, who I've had the privilege of listening to firsthand when I spent some time studying at Wharton Business School myself. And Jeremy Siegel specifically was discussing a topic that I've been talking about. In fact, that's what I learned very much from Professor Siegel, which was liquidity and how important fiscal and monetary policy are. And as I stated before, fiscal monetary policy to the measure that we've seen, we've never seen something like this in terms of the response, the quickness, and the force. Let's actually talk about that. As I said, the U.S. GDP, gross domestic product, is basically all the goods and services in the U.S. economy. The trailing 12 was about 18 to 19 trillion dollars of the U.S. economy, and then we hit shutdown and taking a big Pac-Man bite out of our economy, right, in terms of dollars. And the long-term fallout, as we're seeing from unemployment to everything else, is tragic as it relates to what happened over the last, let's say 60 to 90 days, if you will. So that quarter of taking it out of the U.S. economy, even the economic engine, you're basically shutting it down. Again, you take even a quarter of that, of the GDP, you're about 4 to 5 to 6 trillion plus or minus, depending upon any given day, what's being taken out of the economy. Now, fiscal and monetary policy and their stimulus right now is about $6 trillion that's now working its way in the economy. And the whole idea and the design by this monetary response and fiscal response was to be a gap stop, as I discussed in several daily updates. Now, it's not perfect, right? It's not saying that $1 that is re-injected of liquidity in the marketplace is going to make it to those that actually are in need, and vice versa. But they're going to do their best to actually get the money in the hands of the consumer, and that's measured by the M2 money supply, which is up. Again, Professor Wharton talked about this today on CNBC, up over 20%. We've never seen this in the history of the markets. And what this means is that the money directly is in the hands of the consumer, okay? Unlike 2008, 2009, when the bailout helped the banks and the banks had a solvency issue. So they needed to retain that money to make certain that they would live another day back in the Great Recession that we saw in 2008, 2009. Now, this is a different story, at least what the economic information is telling us and what we were seeing in terms of the empirical evidence that is being reported. The M2 money supply has exploded. The M1 money supply has exploded. Again, money that's in the banks and deposits. So we know the money is there. We know it made it to the consumer. We know it also made it to small businesses. Now, hopefully that's enough stopgap. Now, another question is, will we see another round of stimulus later this week, next week from Congress? We don't know, but it's interesting to see how this is playing out right now, that this money has worked its way in the economy as a result of, as evident by the M1 and 2 money supplies. The S&P 500 broke out to the upside today, broke through the 3,000 mark, which it hasn't seen since February of earlier this year. That's a tremendous positive. As I've discussed on my daily updates, we follow technical analysis here at Blanke Schein Wealth Management. It helps us sort of guide both the short and long-term asset allocation and investments for our clients. And what we were seeing as the most recent weeks that the S&P would be backing up to the 2950, 2999 range, but never quite breaking through to the upside. Well, this morning it did just that. And the positive news is that the financials, a sector within the S&P 500 that has been lagging over the last few weeks, is now actually leading the charge, at least maintaining. Think of it like you're climbing up the mountain with in my family, group of 6, if you will. I've got 4 children. And some of the kids are faster than others, but we're all going to make it up the mountain together. But ultimately, some are going to go quicker, and that's technology, if you will. Think of those sectors. But they're going to take a break along the way, and they're going to let mom or dad catch up. Specifically, in this case, it'll be me. So the sectors that have been lagging, if you will, are financials. And it's good to see them break through or actually participate and finally get to the next phase so that we can see a breakthrough. Now, we're going to see a lot of volatility and a lot of consolidation, a lot of testing now of these technical levels once you get through them. But these levels on the upside is a very positive sign that, the trend is towards making it to the top of the mountain. So that's a great takeaway that we're going to see. We're going to monitor on a daily basis. And yes, the Schein family did make it to the top. And Dad, the financials, if you will, from a sector standpoint in this analogy, eventually made it as well. We're not going to tell you that it didn't break any records, but the good news is that the view from the top was quite rewarding. So that's the S&P 500 breaking through the 3,000 level. And that's our view from Blanke Schein Wealth Management. Markets look through headlines. In fact, they even go way beyond what you and I may feel or even fear, if you will. Markets are now looking to the future, even a year to 2 years and even longer term than that. And looking at today's valuations or even earnings 12 months into the future as we reopen, the S&P 500 and the market itself is indicating right now that we're going to be back. In fact, we might see new highs and set record highs even by year end. And that is quite possible simply because, again, the market looks to the future. And one thing we do know is that the United States always comes back and the market always looks through the tragedy itself or the challenging time, the recession, even the depression as we turn the corner. I think there's a lot of positivity that we're seeing, but the market sees that the earnings are back because there's pent-up demand, okay? But we're also looking at the data, the empirical evidence. So over the last 3 weeks or so, since May 1st, there's 13 states that have reopened. They're, a good 3 weeks ahead of other states that haven't opened. Even countries have reopened, and they've been open for more than a month now in some respective countries around the world. And what we're finding is the trend not only around the world, so it doesn't matter sort of who you want to look at or cherry pick the data you want to see, the trend is our friend as it relates to new cases, even though testing has gone up dramatically, right? So the market is seeing that you can sell a headline or you can, sort of report the way you feel, which could be fear-based, but this is acting like all other viruses. Now, I'm not saying that this isn't something to not worry about or care for, and not even making a medical comparison as it relates to the COVID-19 virus, right? That is set aside. What we're looking at right now is the evidence before us, economically speaking, from what the economic numbers are or what the earnings numbers could be on a go-forward basis, which is still an unknown. But the markets are pricing that in and looking at the reality check of saying, if this trend persists and continue, and we have 20% up in money supply, meaning the consumer and small business actually have the money of the $6 trillion. So that's actually in the system. And they have the opportunity to go out, right? Leave your house and start consuming, if you will. And we're a consumer-driven economy. Of course, it's going to be limited in nature of what we knew. And it's going to take time to get back to where we were. But there is an opportunity for us to see higher highs, even by year end, which is hard to believe. But we'll look back on this tape and see if we're right by year end. So hopefully that is the trend continues, that the new cases continue to decline, the death rate continues to decline, all the medical information starts trending and continue to trend in the right direction, all the while the market is looking at future forward earnings as you and I decide to, what's safe for our respective families and the timing of which to go back out. So that's an update for today as it relates to, higher highs by year end. And our belief here at Blanke Schein Wealth Management, it's not off the table, but the market's going to have, a lot of time between now and year end to sort of sort through all of the fits and starts of good economic data and bad economic data, and positive medical news and negative medical news. In fact, that's what makes an up market, but ultimately that's what yields the most opportunity on a go-forward basis. My last topic of the day is inflation. Long term, we will have inflation. In fact, with the $6 trillion that's basically now injected in the U.S. economy by function of M2 money supply spiking by over 20%, it's been unprecedented. And long term, we're going to see the effects of this for years to come. Short term, the reason why monetary policy and fiscal policy sort of get together and inject all that money is to stem off the trajectory at the time. What we saw a recession going into a depression type transition for the U.S. economy as we shut down. In a short term, you get deflation, but long term, it turns into inflation if it's done properly, because you have so much money and liquidity that's injected into the marketplace. As a perfect example of this, in sort of a times that are changing right now that we're seeing, as states reopen, it's a function of supply and demand. I want to take my family later this summer on a little road trip, let's say, to the beach, and I've been looking at travel websites over the last few weeks, and what I found was hotel prices are now going up, because much like our family, all families want to get out there, right? So the demand is tremendous. In fact, we believe that there's tremendous pent-up demand in all aspects of the U.S. economy right now, simply because of the shutdown. But the supply is also down as well, and that's what's causing inflation in these prices, right? So hotels can't open up to 100% capacity. I don't even know if it's 25 or 50%, but it's going to be a fraction of what they're traditionally accustomed to, especially in the summertime. But with that short supply on the market, we're seeing hotels that I saw a week ago now are completely at full capacity. Prices are going up, and a lot of them are sold out. So that's my little empirical evidence of what I see. The net take-home point is that there is, that demand out there. That was part of the concern out here, which is if you reopen the economy, do people will demand reopen, and will that happen, and will it be there once everyone reopens? So that's good news long term, that consumers are going to continue to consume. So it's all function of a big sort of lesson here that we've discussed, which is monetary policy came to the rescue. We've got over 20% of deposits in the banking system. Consumers now feel, day by day, they feel a little bit better about going out. And then once they're out, now they're returning, and it's causing an inflationary effect because supply is limited. And that's just an example in the travel aspect. I think we're going to see that more and more on every aspect of the economy as we continue to trend in this direction. So thanks for watching today, and have a great day.